Welcome. Good evening. I am sure you have done very well in your advanced accounting paper. This is Jan 2025. Okay, CA Inter Advanced Accounting Paper Review, guys. We will discuss all the MCQs in detail and we will go through the descriptive part as well. Watch this video till the end to get the answer for all the MCQ answers. So 30 marks MCQ, easy MCQs asked by ICAI. Okay, let's dive deep. First question, case scenario they have asked. See this case scenario, the following summary cash account has been extracted from the next page limited's accounting records. You can see over here cash sale. Cash sale is what, guys? Operating activity. Trade receivable, operating activity. Rent from property held as investment, you're holding it as investment, so obviously it has to be investing activity. Income tax refund will be cash flow from operating activity. Loan from bank has given you a loan, so it is going to be financing activity. Issue of shares is also going to be financing activity, and sale of investment is going to be cash flow from investing activity. Then trade payable, you're paying your creditors, operating activity. Office and selling expenses, operating activity. Trade commission, operating activity. Underwriting commission you're paying, that is for issue of shares. Financing activity. Redemption of preference shares is also financing activity. Brokerage on sale of investment will be investing activity. Interest on long-term borrowing will be financing activity. Payment of overhead will be an operating activity, and finally purchase of goodwill will be a cash flow from investing activity. Okay guys, let's see what they have asked now. First question you can see over here. Okay, which of the following would be considered as cash flow item on from investing activity? In trade commission is obviously operating activity. Underwriting commission is also financing activity. Interest on long-term borrowing is financing activity. Purchase of goodwill will be your investing activity. That is your option C. Let's go into question number 2. What would be the cash flow from operating activity? Okay, we have already solved this. Cash flow from operating activity. You can see over here, this plus this plus this minus these things and minus, that time you will get your cash flow from operating activity. Again, I'm going to tell you guys. Okay, cash sales, trade receivable, income tax refund. Add that, then minus the trade payable, minus the office and selling expenses, minus trade commission, minus the payment for overhead. That time you should get the answer. Okay, you should get the answer as, yes, 1,54,500 cash flow from operating activity. Okay guys, let's go further. What would be the value of cash flow from investing activity? Cash flow from investing activity, like have a look at this, 64,000 plus sale of investment minus brokerage minus purchase of goodwill. Those two you add, then these two you minus. That time you should get your answer, and your answer should be 54,300. That is your option B. Option B. Let's go to the fourth question. Fourth question is at the end in our material. What would be the value of cash flow from financing activity? Financing activity, what is the value they are asking? Financing activity, let's go deeper. Let's go and have a check over here. You can see loan from bank is financing activity, plus issue of shares is financing activity, plus then underwriting commission is financing activity, minus outflow, redemption of preference shares outflow, interest on long-term borrowing is also outflow. So when you do that, you can see the inflow is much less than outflow. So the answer that you're going to get is 1,60,600 is negative. That means outflow. This is your cash flow from financing activity. This was your question number 4. Let's go into question number 5. Glow Limited had taken loan of 5 lakhs on June 2023. When did they take the loan? June 2023. The loan is repaid in 10 half-yearly equal installments starting from December 2023. We are on 31st March 2024. How the remaining loan will be classified as per Schedule 3? Now December 2023 we are in. June 2023 the loan is taken. That means 50,000 is already paid. So how much is remaining from the loan? Only 4,50,000. Remember, whatever is payable within the next 12 months, that is going to be considered as short term, and what is going to be paid after that is going to be considered as long term. So can you have a look at this? 3,50,000 is shown under the long term borrowings, and 1 lakh is shown under the head short term borrowings. Clear? Because 1 lakh will be paid in the next 12 months and 3,50,000 will be paid after that. That is question number 5. Let's go into question number 6. Question number 6. Yeah, we have a case scenario over here. Now, on 1st April 2019, Black Limited received a government grant of 15 lakhs. Acquisition of machine costing 50 lakhs. Okay, 50 lakh machine we acquired. 15 lakhs is the government grant. The grant was credited to the cost of the machine. Life of the machine is expected to be 10 years and estimated residual value at the end of 10 years is 5 lakhs. Estimated residual value at the end of 10 years is how much? 5 lakhs. Company charges depreciation on straight line basis. Everything is going smooth. Okay. Due to non-fulfillment of conditions, the company had to refund the entire grant on 1st April. 2 years, everything went smooth. 1920 and 2021, everything went smooth. Then after 2 years, what we had to do? We had to refund the grant. Okay. On 31st March 2023, after refunding, everything went smooth again for 2 years. On 31st March 2023, Black Limited received certain indications of impairment and machine, and the recoverable amount was ascertained to be 28 lakhs with a revised useful life of 4 years and nil residual value. Okay, now let's see till here. See, 1st April 2019, 50 lakhs. Government grant is received, remove it from, they said it is removed from the cost of the asset itself. So the asset value becomes 35 lakhs. Now what you're going to do, everything is smooth. According to you, in your head, everything is smooth. 35 minus 5 divided by 10 years, 3 lakh per year is a depreciation. Okay, 1920 you remove depreciation, 2021 you remove depreciation. Now you are having 29 lakhs. 29 lakh is the value of the asset. 2 years later, what happens? Government grant becomes refundable. When you're refunding the government grant, you're going to add 15 lakhs again and the value of the asset goes back to 44 lakhs. 44 lakh is the value of the asset. Okay. Now what happens? Everything is smooth for 2 more years. 44 lakhs minus 5 lakh, which is the scrap value, divided by 8 years, you're getting 4,87,500 as a depreciation. 21-22, 22-23. It's going at as per 4,87,500. Now you are having the value of 34,25,000 in your books. Now they are telling recoverable amount is only 28 lakhs. Impairment has happened. 6,25,000 is impairment loss. Okay, 31st of March 2023. Then what happens? 1st April 2024. That means 1 more year later, company exchange the machinery by paying cash. Now here, this is not by paying cash, by receiving cash. This is a mistake that ICA has done. If you see, if you take paying cash, you will not get the answer at all. By receiving cash of 2 lakhs and new machinery valued at 18 lakhs. Now if you see over here, 31st March 2023, Black Limited received certain indications of impairment and also revised useful life is 4 years only and nil residual value. Now see, 1 more year. Now what you're going to do, 28 lakhs is the carrying amount because you have done impairment. Impaired value of the asset is 28 now. Depreciation for 23-24 is 7 lakhs because 4 years useful life divided by 4. That time you're getting 7 lakhs. Now 21 lakh is the value. 21 lakh is the value. What are you getting? 2 lakh you're getting cash. It is getting cash, not paying. 2 lakh you're getting cash and 18 lakh you're getting new machinery. So total what you're getting is 20 lakhs. What you have in the books is 21 lakhs. What you're getting is 20 lakhs. Loss on exchange is 1 lakh. So that should be option number A. Loss on exchange is 1 lakh. Now they are asking what will be the carrying amount of the machine on 31st March 2021 after charging depreciation for the year. 31st March 2021, we already have it in our calculation. Can you see? 31st March 2021, we are over here. After charging depreciation, the value is 29 lakhs. Okay, 29 lakhs. You can see over here, value is 29 lakhs after charging depreciation. Okay. Next, what will be the amount of depreciation to be charged on the machinery for the year ended 31st March 2022? What is the amount of depreciation to be charged on 31st March 2022? We have calculated that also. That is 4,87,500. Can you see the answer is 4,87,500, option B. What will be the impact of test of impairment on P&L? What is the impairment effect they are telling? That also has been computed. 6,25,000 is our impairment loss. You can check impairment loss 6,25,000 to be debited to P&L account. Okay guys, let's go further. Now what did they ask after that? Next question. Okay, that should be easy case scenario which is going to fetch you marks in the exam. Now let's proceed to the next case scenario. Okay, have a look at case scenario 3. The following particulars are stated in the balance sheet of Star Limited as on 31st March 2023. They have deferred tax asset, okay, and they have deferred tax liability. Both are there. Now depreciation as per records, this is going to cause a difference of 6 lakhs. Okay, interest paid accounted in the books on accrual basis but paid on 15/5. Interest, if you have accounted, if you pay it within the due date for filing return of income, still you can claim it under tax. So this one, it is allowed as per accounts also, it is allowed as per tax also. It is paid within the due date, so there is no problem there. Employer PF contribution disallowed for tax purpose in last year. Last year they had disallowed it, but allowed in the year 2023-24. Okay, good. Unamortized preliminary expense as per tax records. Taxation, what happens? Preliminary expense, they allow you to take preliminary expense in 5 years. Okay, here in accounts, what you will do, entire amount you will take it in 1 year itself. Okay, donation 70,000, tax rate is 20%. Can you see over here? First question that they asked is, what is permanent difference? Employee PF contribution, we saw it is not permanent difference. Last year they disallowed, this year they are allowing. Unamortized preliminary expense, we know they are going to allow it over a period of 5 years. Depreciation also we know it is going to be allowed as per taxation as well as accounts. Donation is the one which is causing permanent difference. Permanent difference is donation. 11th question. What would be the value of deferred tax asset as on 31st March 2024? 31st March 2024, they are asking you what is the value of deferred tax asset. Clear? Now here if you notice, what is the deferred tax asset, what is there over here? We already have deferred tax asset of 1,20,000. 1,20,000. If you see here, depreciation as per tax is more. If depreciation as per tax is more, that means as per tax income is less. If income is less, tax is less, that means in future you are going to pay more tax. This will cause deferred tax liability. This will cause deferred tax liability. Okay, no impact on asset. Now this one is not going to cause any trouble. Employer PF contribution. Last year they didn't allow, this year they allowed. Last year when they did not allow, that time you paid more tax and you calculated that as deferred tax asset. This time when they are allowing, deferred tax asset is going to get reversed. So 82,000 into 20% tax, 8,200, 16,400 is going to get reversed. So you have deferred tax asset of 1,20,000 minus 16,400. Minus 16,400. Clear? Now unamortized preliminary expense. Unamortized preliminary expense, as per tax they did not allow you to take preliminary expense, but in future they will allow you. So in future if you are going to pay less tax, it is deferred tax asset creation into 20%. So plus 20,000. Plus 20,000. Okay, have a look at this. That is going to be, okay, 1,20,000 minus 16,400 plus 20,000. That makes it 123,600. So your answer should be 1,23,600 is the value of your deferred tax asset. Deferred tax asset. Next, what will be the value of deferred tax liability, guys? Liability, you see, only one thing is impacting deferred tax liability. This has no impact. This is DTA reversal, which we have already taken. This is DTA creation, which we have already taken. So deferred tax liability is 2 lakh over here. 6 lakh is the difference between the depreciation into 20%. That makes it 1,20,000. So 210 plus 1,20,000, that is going to make it 3,30,000. So you can go and check the answer. It is going to be 3,30,000 is the value of your deferred tax liability. Deferred tax liability is 3,30,000. One more question they have asked based on the same case scenario. What would be the value of reversal of deferred tax asset on 31st of March 2024? Reversal of deferred tax asset we have already calculated. Can you see here 82,000 into 20%, 16,400. So answer is 16,400, reversal of deferred tax asset. Okay. Next. Okay, let's go to question number 14. ACE Limited borrowed 25 lakhs from ABN Bank during the financial year 23-24. Okay. ACE Limited used these funds to invest in equity shares of K Limited. What did they do with these funds? They invested in the equity shares of K Limited. Okay. K Limited is implementing a new project. So they are constructing some building or something. So with these future prospects, ACE Limited invested 25 lakhs in K Limited. They saw that K Limited is making some good future plans. So they invested 25 lakhs in K Limited. Okay. As on 31st March 2024, since the said project was not complete, the directors of ACE Limited capitalized the interest on loan amounting to 2 lakhs and thus the amount of interest to the cost of investment. What did they do? ACE Limited has borrowed loan and invested. The interest which is there, they have added it to their investment value. Remember AS 16, only when loan is borrowed which is related to qualifying asset. Qualifying asset means what? Asset which takes substantial amount of time for it to be ready for its intended use. Here investment, your purchase shares already done. It is not even a qualifying asset, but they have done a mistaken thing over there. Market value of this investment on 31st March 2024 is 24 lakhs. Okay, identify the correct statement considering the facts as per AS 16. We'll see. Since project is qualifying asset, okay, don't even read further. Project is qualifying asset, yes, but for whom? Not for us, no. Directors of AS Limited correctly added it to the cost of investment. It is qualifying asset for whom? Not for us. It is qualifying asset for K Limited. K Limited is the person who is implementing new project. For us, it is not qualifying asset. So this is absolutely wrong. Interest paid is acquisition charge. Hence, directors of AS Limited correctly added. No. That is also wrong. AS Limited invested in equity share, which is not a qualifying asset. Okay, going in the right direction. Therefore, directors are wrong to add the interest in cost of investments. Rather, it should be charged to P&L. Absolutely correct. Option number C is the answer. We'll see D also. Since project is qualifying asset, okay, no need to see further only. It is not even qualifying asset. So our answer for this one will be option number C. 14 questions of MCQ done. We go into the last one, guys. Last one. Okay, next question, guys. AB Contractors undertakes a fixed price contract for 350 lakhs. Okay, information relating to the contract is given as under. Material purchased 125 lakhs. 125 lakh of material is purchased. Okay. Labor charges 95 lakhs. Unused material is 22 lakh. That means it's not used. So material will be what? 125 minus 22. Material will be 103. Okay. Labor will be what? 95. That makes it 198 expense till now. Estimated future cost to complete is 115. Payment received as per part payment. Okay, 50 lakhs we have received. Machinery used for 4 years for the contract. Original cost of the machinery is 210 lakhs. 210 lakhs. Expected life of the machinery is 20 years. We have used 4 years. 4 by 20. So 210 into 4 divided by 20 is going to become 42 lakhs. This makes it 240 lakhs. Totally that we have spent is 240 lakhs on the contract. And they are telling 115 lakhs. Estimated cost to complete is 115 lakhs. That makes it 355. Totally we will need 355. In AS7 we have seen whenever we see that a total cost is going to exceed the contract revenue, that means the loss has to be recognized. Contract revenue is 350. We are expecting that 355 will go from our pocket. Loss on the contract is 5 lakhs. Loss on the contract is 5 lakhs. These are your MCQ questions. 15 questions to 2 marks each. I hope it went well, guys. Okay, please do comment how much you got right in the exam so that you can focus better on the next exam. Okay, let's go into the descriptive part. Okay, descriptive part, guys. Let's go into descriptive part. Okay, XYZ Limited has provided you the following information as on 31st March 2024. Okay, very good. Okay, net profit after tax. Net profit after tax 31,20,000. Number of shares outstanding on 31st of March 2024 is 8 lakhs. Average fair value of one equity share during the year 23-24 is given. Average fair value. Okay. Weighted average number of shares under the option. Option is there. Okay. This can cause diluted EPS. It can cause diluted EPS. Now, exercise price of the share is also given 20. Okay. 12% debentures of 100 each. We have debentures. Each debenture is convertible into 4 equity shares. So, okay. This can also cause. So, each debenture is convertible into 4 equity shares. So, this also will cause diluted EPS. Tax rate is 30%. Tax rate is 30%. Anyways, net profit is given after tax only. Company issued 1 equity share as bonus for 5 equity shares outstanding on 1st October 2023. It further, for bonus, what you have to remember, weightage will be for full year. Whenever you're calculating bonus issue is there, weightage for weighted average number of shares when you're calculating, bonus for weightage will be given for the entire year. It further issued 2 lakh equity shares of 10 each as on 1st April to 1st January 2024. Okay, for this you will give weightage only for 3 months because it is fresh issue. Financial year of the company ends on 31st March every year. You are required to calculate basic EPS and diluted EPS on 31st March 2024. Okay, easy question, guys. Basic EPS when you are calculating, remember to give weightage from the starting of the year. Okay, for bonus shares, and for the other shares you have to give weightage only for the respective time period. Dilution will be caused by options as well as it will be caused by convertible debentures. Easy 5-mark question from AS20 asked in the exam. Let's go to the next one, guys. J Limited availed an equipment on lease from K Limited. The conditions of the lease are as under. Okay, conditions of the lease are as under. Lease starts from 1st April 2020 for a period of 4 years and useful life of the equipment is 6 years. Out of 6 years, 4 years is covered by lease. Okay. Both the cost and fair value of the equipment is 12,50,000. cost of the asset, and fair value of the asset is also 12,50,000. Equipment reverts back to the lessor on termination of the lease. So when the lease gets over, equipment doesn't stay with me, it goes back to the lessor. Okay. Unguaranteed residual value is estimated as 1,20,000 at the end of the financial year 23-24. Unguaranteed residual value they have given. The amount will be paid in 4 equal installments at the end of each year. Consider IRR as 8%. Present value of rupee 1 for 4th year is given. Present value of rupee 1 of annuity is also given. State whether it is an operating lease or finance lease by applying 2 deterministic parameters. Also calculate unearned finance income. Unearned finance income is what? How will you calculate unearned finance income? You will calculate gross investment minus net investment. Net investment is what? Nothing but present value of gross investment itself. Gross investment is what? The lease rent that you're supposed to get. Okay, minimum lease payment plus guaranteed residual value plus unguaranteed residual value. Take the present value of that, you will get the net investment difference between the two. Whatever difference you get between the two, that should be your unearned finance income. And to see whether it is operating lease or finance lease, what should you do? You should see, can you see the minimum lease payment? Okay, lease payment you have to calculate. After that, 5-mark question, yes, lease payment we have to calculate. After that, what happens? You have to calculate whether present value, okay, present value of MLP from lessee's point of view, whether present value of MLP from lessee's point of view is almost equal to the fair value of the asset. Fair value of the asset is given here 12,50,000. If it comes close, that is a finance lease. Otherwise, it is an operating lease. One parameter is already solved. Out of 6 years, 4 years lease. So majority of the time period is covered by the lease itself. Another parameter you have to solve is you have to calculate whether present value of MLP is almost equal to the fair value of the asset. Okay, this is an easy question from AS 19. Okay guys, next. What is the difference between defined contribution plan and defined benefit plan? What is defined contribution plan? Defined contribution plan means employer contributes. That is the end of the story. Risk is on the employee after that. Defined benefit plan means what? Employer is promising that I will give you some benefit at the end of the termination of your employment agreement. Okay, so the risk is on employer over here. From the following information, calculate the amount of defined benefit liability. You can see present value of defined benefit obligation is given. Fair value of plan asset is given. Past service cost not yet recognized is also given. Present value of available future refund from the plan. Okay, easy. AS 15 question. Straight away they have picked this question from the study material itself. Same kind of question is there in the study material. This shouldn't cause any trouble. Okay, let's go further guys. 14-mark question. 14-mark question. Sustain Limited is incurring loss due to adverse market conditions. Okay, looks like they are leading to internal reconstruction. It decided to reorganize its capital structure. Summarized balance sheet of the company as on 31st March 2024 is as follows. They have given the balance sheet. You can see the share capital. You can see the loss sitting over here. Okay, long-term borrowings. Trade payable, short-term borrowing, bank OD, other current liabilities, interest payable on the debentures, outstanding interest, short-term provision from income tax. When we go to asset side, property, plant and equipment, intangible asset, non-current investment is also there, inventory, trade receivable, okay, cash and cash equivalent is not there because there is bank OD. When you look at share capital, can you see 50,000 equity shares of 10 each fully paid up and 25,000 equity shares of 10 each 8 paid up. That means partly paid up shares are there. Then we also have 30,000 8% cumulative preference shares of 10 each. Preference dividend has been in arrears for 3 years. Last 3 years they have not paid dividend only. Okay. P&L debit balance. You can see the loss here. 10% debentures. Property and plant and machinery. 2 things we have. Goodwill, non-trade investments at cost. Internal reconstruction. Subsequent to approval by court and all interested parties, the following scheme of reconstruction were agreed. Okay. What did they ask you? Prepare journal, show the journal entries. Okay, and prepare note to show the revised share capital, okay, of the company after completion of the scheme. Only share capital they have asked. Next, uncalled capital is to be called up in full and such shares and other fully paid up shares are to be reduced to 5. So first what you're going to do, uncalled capital is going to be called up. So you'll pass the entry, equity share, final call, debited to equity share capital account. Then you're going to get the money. So bank account debited to equity share final call. Bank account debited to equity share final call. These 2 things we are going to do. Okay, this is going to be your entry. Then what to do? All the shares are reduced to 5 per share. All the shares means what? 50,000 plus 25,000. All the shares are reduced to 5 per share. So 75,000 into 5 rupees, 3,75,000. Okay, 3,75,000 will go into capital reduction. 3,75,000 will go into capital reduction. The entry will be equity share capital to capital reduction. Equity share capital debited to capital reduction. Now, the preference shares will accept a reduction of 2.5 per share in exchange rate of dividend to be increased to 9%. Now, what is the interest or preference share dividend rate? 8%. They're going to increase it to 9%. So now it is showing 3 lakhs. So now it will be 8% preference share capital debited, 3 lakhs to 9% preference share capital. Now it's going to be 2.5 reduction. So 3 lakh. So 1 second. Yeah, it's going to be 2.25 lakhs, 2,25,000 to capital reduction 75,000. 75,000 will go into capital reduction. Okay, then preference shareholders will forego their claim of dividend for 1 year and 1 equity share of 5 each to be issued for the remaining arrears of dividend. How many years dividend is pending? 3 years. 1 year they are going to let go. So 3 lakh into 8% into 3 years. 3 lakh into 8% into 3 years, that is going to give you 72,000. 72,000. Now if you see over here, 72,000 is the pending interest. Okay, 1 year we are going to let go. For this there is no entry. What is not there in the balance sheet, we are going to remove it, no entry. But 2 years we are going to pay. So what is the 2 years now? 24 into 2, 48,000. 48,000, what we are going to do? Give 1 equity share of 5 each to be issued for the remaining arrears. So 48,000 divided by 5. 48,000 divided by 5, you are getting 9,600 shares. You are going to issue 9,600 shares. The entry for this will be capital reduction debited 48,000. Okay, to equity share capital 48,000. This is going to be the entry. 9,600 shares are issued. Okay, guys, let's go further. Mr. X holds 10% debenture of 2,50,000. He is also a creditor for 50,000. He agreed to cancel 50% of his total debt, including interest on debentures, and paid 20,000 to the company and receive new 12% debentures for the balance amount. This we have seen, X has to be created and then we have to remove X altogether. So now first what we are going to do, 10% debentures. He is having 10% debentures for 2,50,000. So we'll do 10% debentures debited 2,50,000. And he is also creditor for 50,000. So we are going to write creditor debited 50,000. Then he also agreed to cancel his total debt including interest. If he is having 2,50,000 debentures, 2,50,000 debentures, how much will be the outstanding interest that fellow is having? Outstanding interest, you can see over here. Interest is how much? 45,000. Can you see 1 year's interest is pending? 1 year. So 25,000 interest is also there. Outstanding interest debited 25,000. Outstanding interest debited 25,000 to X. So 3 lakh 25,000. What is X going to do? X is going to give more money, pays 20,000 to the company. Okay, very good. Bank account debited 20,000 to X account 20,000. So now X has to give us 3,45,000. Okay, and company, and to receive new 12% debentures for the balance amount. 50% of his total debt he'll cancel. So now what he will do now, 50% of the total debt he'll cancel. So 3,25,000 is going to be cancelled plus 20,000. Okay, we can do one thing. 3,25,000. Out of 3,25,000, half is cancelled. 50%. So 3,25,000 into 50% is 1,62,500. This is cancelled. This will go to capital reduction. Okay, it will go to capital reduction. Now, what will happen? Now, understand this. You can see X account. You can ignore this entry. You can pass it compound. You can pass the compound entry. X account debited 3,25,000. And he is going to give cash. Cash account debited or bank account debited. Don't write cash. Bank account debited 20,000. Okay, to capital reduction 1,62,500. And you're going to issue new debentures. So 3,45,000. 3,45,000 minus 162,500. 1,82,500. What percent debentures? 12% debentures. 1,82,500. 500. This is going to be the situation. So what we are going to do, first calculate, you have to give him debentures, you have to give him, he's part of trade payable also, and outstanding interest is also there. Okay, half of that cancel. And he's going to give 20,000, money comes in and you're going to give debenture for that. So remaining half you're giving debenture, and for the 20,000 which he has given, you're going to give debenture. The remaining claim of the debenture holders, including outstanding interest, is to be reduced to 60%. Remaining claim of the debenture holders, including outstanding interest. X is gone. Other people are still there. No. Reduced to 60% in consideration of the reduction. Because they agreed to reduce, the debenture holders are to receive new 9% preference shares at face value. Reduced to 60%. That means 40% is going to be removed. No. So now what you're going to do? How much is the remaining debenture? Out of 4,50,000, out of 4,50,000, 2,50,000 is gone, which was held by X. How much is remaining now? 2,00,000. So now 2,00,000 is the debenture and 20,000 is the interest. So 2,20,000. 2,20,000. So if you see now 2,20,000. 1 second, guys. Yeah, 2,20,000 into 60%. Okay, so 40% is going to be removed. 2,20,000 into 40%, you're going to remove 80,000. So what you're going to do? 80,000 is going to be removed. So now you can pass the entry. Okay, you can pass the entry. 88,000 is removed. So 88,000 will go to capital reduction. Here 88,000 will be transferred to capital reduction. And now, because they agreed, what we are going to give them? New 9% preference shares at new face value. Okay, in consideration of the reduction. Because they agreed to reduce this, we will give them preference shares. Okay, so we are not going to give them anything extra. 88,000 we are going to reduce. So directly you can pass instead of capital reduction. 88,000 will be debentures debited, outstanding interest debited directly to 9% preference share capital account 88,000. Okay, this will be 88,000 in total. Taxation liability is to be settled at 120. How much is the provision we have right now? Provision for taxation is sitting at, where is it? Yes, 1,00,000. You are going to pay 120. So now what happens? 20,000 you are going to take from capital reduction. Provision debited 1,00,000. Capital reduction debited 20,000. Okay, to bank 1,20,000. Okay. Market value of non-current investment is 250. Investment to be brought to their market value. Go and check how much is the investment. 280. We are going to bring it to 250. So capital reduction debited 30,000 to investment 30,000. Inventory equal to 1,00,000 at the book value will be taken over by remaining creditors in full settlement of their claim. In full settlement of their claim, they are going to take inventory of to the book value of 1,00,000. Okay, will be taken by remaining creditors. Remaining creditors are how many? We have creditors over here. Can you see? Yes, creditors are sitting at 130. Out of that, how much did X have? X had 50,000. Out of 130, if you remove 80,000, it becomes 80,000. 130 minus 50,000. That means remaining creditors are 80,000. What did they agree to take? Yes, remaining creditor will take inventory. Now you will write creditor debited 80,000. Inventory gone 1,00,000. That means capital reduction debited 20,000. Okay. Bad debt provision of 2% is to be created on trade receivable. See the value, see trade receivable, create the provision. Capital reduction debited to provision for bad debts. Plant and machinery is to be written down by 20%. Go and calculate plant and machinery. What is the value? Then the entry will be capital reduction debited to plant and machinery. Okay. Company will further issue 12% debentures of such amount which is sufficient to pay off bank OD and other outstanding liabilities and maintain cash balance of 85,000. Okay. Go and check how much liability we have. Sorry. How much liability do we have? Okay. We have over here bank OD is there. Okay. Short-term borrowing 65,000. Other current liability is not there. Okay. Now see very important sentence over here. Company will further issue 12% debentures for such amount which is sufficient to pay off bank OD and other outstanding liabilities. Other outstanding liability means outstanding interest and maintain cash balance of 85,000. Right now in this question, anywhere did you get any money? Okay, only money that you have received is when X gave you some 20,000. X gave you 20,000. That is the only amount you have received. So what you are going to do over here in this question, you are going to see how much is the bank OD. Bank OD plus remaining outstanding interest. Outstanding interest 40% was waived off. Now 60% is remaining. Okay, remaining outstanding interest. Okay, this whatever value you get. Okay, plus 85,000 minus X had given how much? X had given 20,000 minus 20,000. So whatever may be the balance amount, for that you have to issue debenture. Debenture issue. For this you have to issue debentures, because we don't have money, issue debentures, get money and do all these things. Next, amount available by the scheme shall be utilized in writing of the goodwill and debit balance of P&L and balance of inventory. Okay. Now what we are going to do, whatever is their balance of capital reduction, how much is there in capital reduction, just be careful, use it to write off the goodwill. So capital reduction account debited to goodwill, and then capital reduction account debited to P&L, and then remaining use it to write off the balance of the inventory. After that, if you have any amount, that is transferred to capital reserve. Otherwise, if there is no amount, balance of inventory will be written off. Okay, these are the entries which you are going to pass. Prepare note for share capital. Why did they tell share capital note? Because equity shares, if you see, equity shares, you have 75,000 shares over here, and one place you have issued shares. 9,600 equity shares are issued. Other than that, you have not issued equity shares to anybody. Preference shares you can see over here. 30,000 preference shares are there. Values have changed. Be careful. We have changed the values. Preference shares, what happened? Preference share capital. We have issued some preference shares again over here. Yes, 9% preference share capital for 88,000. So they have asked you to prepare the share capital note. This should be a 14-mark question. You have to be on your top speed to finish this. Okay, within time, because you have so many entries to calculate and you have to pass. Luckily, they didn't ask balance sheet. They only asked you to prepare note for share capital. That was your question number. Yes, that was your question number 2. Now we'll go into question number 3. 3A. And engineering goods company provides after sale warranty for 2 years to its customer. Based on the past experience, company has been following the policy for making provision for warranties on the invoice amount on the remaining balance warranty period. Invoice less than 1 year, 2.5% provision. Invoice more than one year, 4.5% provision they are going to create. The company raised the following invoices. You're going to check which is going to be less than 1 year or more than 1 year, and accordingly you're going to create provision. Calculate provision to be made. AS 29, direct question. See how much is on 31st March 2023 and 31st March 2024. On 31st March 2023, you see invoice date. So how much they are giving after sale warranty of 2 years to its customer. So on 31st March 2023, you see all these invoices. Okay, invoice less than 1 year. Do we have balance warranty period less than 1 year? If it is less than 1 year, calculate 2.5% of that. Whichever invoices have a time period of more than 1 year, you calculate. Sorry, invoices which have completed less than 1 year, 2.5%. Invoices which have completed more than 1 year, you calculate 4.5%. First you calculate on 31st of March 2023, then when we go to 31st March 2024, whatever was less than 1 year in 23, it will become more than 1 year in 24. So that time it will become higher rate of provisioning. Also compute the amount to be debited to P&L for the year ended 31st March 2024. Easy question they have asked. Okay, 7 marks from AS 29. First you have to calculate on 31st March 2023, how many invoices have completed less than 1 year, more than 1 year. Accordingly, the provisioning rates are given over here. The provisioning rates are there, 2.5%, 4.5%. Accordingly, you have to calculate. Yes. B. Given below are the extracts of the balance sheet of BGH Limited. They have given two balance sheets here. Share capital, P&L, 10% debentures issued at the end of the year. Bank loan, trade payable, dividend payable is also there. Okay, interest payable on bank loan. Current year, interest payable on bank loan. Okay. Then you have goodwill, trade receivable, inventory. You are required to prepare for the year ended 31st March 2022, cash flow from operating activity, cash flow from financing activity. Two things they have asked. 7 marks question. Share capital. They have asked operating and financing. Can you see share capital has increased? Obviously, it is cash flow from financing activity, positive amount because the amount has increased. Okay, P&L. Can you see P&L has increased? This is what your retained earnings. When you are calculating under indirect method, this is your retained earnings. 50,000 is your retained earnings. Okay, 10% debentures. It was 0, it became 1 lakh. That means cash flow from financing activity, obviously plus. Why they told end of the year? Because interest is not there. You don't have to pay interest here. Bank loan 2 lakh became 2 lakh 50. This is also cash flow from financing activity. Okay, minus, sorry, plus because you have borrowed more loan. Trade payable 75,000 became 60,000. It has reduced. So working capital changes. You are going to show under working capital changes 15,000 minus. Then dividend payable 50,000 became 0. That means dividend is paid. So cash flow from financing activity you are going to show minus. Interest payable on bank loan. Interest payable on bank loan, outstanding interest. So what you're going to do, this is also going into working capital changes. Working capital changes, what you're going to do, you're going to show it as plus. It has increased from 20, it has gone to 25. Plus goodwill, what you're going to do, it has nothing to do. It will go into 1,50,000 became 1,20,000. This is basically amortization. Amortization, what you're going to do, cash flow from operating activity, you're going to add back because it is non-cash item. Trade receivable has gone down. So in working capital changes, it has gone down. So you're going to add. Inventory has gone up. So in working capital changes, you're going to minus. Any information about tax is not there. This should be your cash flow from operating activity and cash flow from financing activity. Operating activity, what you're going to do, indirect method, you have your starting point as retained earnings. Yes, this should be your question. Next, we'll go into question number 4. Can you see 14 mark question? Nicely asked. 14 mark question. Question number 4. Following are the summarized balance sheets of Light Limited and Bright Limited as at 31st March 2024. Okay, you have Light Limited here, you have Bright Limited here. Equity and liability, shareholders fund, share capital, reserves and surplus, long-term provisions, trade payable. Non-current assets, property, plant and equipment, inventory, trade receivable, cash and cash equivalents. Small question, small balance sheet, rupees in lakhs, they have told. Okay, obviously notes to accounts is there. Share capital is given of both the companies. Okay, statutory reserves, general reserves, securities premium, P&L. Okay, land and building, plant and machinery and other assets. Let's see what they have asked, guys. A company, Rainbow Limited, is formed to acquire the assets and liabilities of both companies. Both are selling companies now. Rainbow Limited is the new purchasing company. Assets were acquired at book value except land and building of Light Limited, which is revalued at 62 lakhs. Okay, moment you saw that asset is revalued, it is amalgamation in the nature of purchase. You don't even have to bother about amalgamation in the nature of merger. Okay. Other assets of Bright Limited are obsolete and are scrapped and sold for 50,000 by Bright Limited itself before acquisition of its assets and liabilities by Rainbow Limited. That means not taken over. Other assets are not taken over. Remember this. Other assets are not taken over. Light Limited and Bright Limited will be issued 80,000 and 64,000 equity shares of 100 each, respectively, of new company Rainbow Limited in lieu of purchase consideration due to them. Directly PC boss, PC. They have told that this much shares are issued, this much shares are issued. Till now we feel that it is net payment method. Okay, we'll see what happens. You are required to prepare. Oh, nothing is there. Realization account and equity shareholders account in the books of Light Limited and Bright Limited. Both the companies you have to prepare realization account and equity shareholders account. Opening balance sheet of Rainbow Limited. All the assets are taken over. What is not taken over? Other assets of Bright Limited. Can you go and see over here? Bright Limited. What is not taken over by Bright Limited? Other assets. See here. Other assets of which company? Bright Limited. Other assets of Bright Limited is not taken over. Okay, that is scrapped for 50,000. This is the only thing. Other than that, all the assets are taken over. In fact, the land and building is revalued at 62 lakhs. So first you have to close both the books, realization account and equity shareholders account. When you are in Bright Limited, what happens? All the assets and liabilities taken over are transferred to realization account. Other assets are not taken over. So that other asset will not be transferred to realization account. You will sell it and the profit or loss only will go to realization account. Is this clear, guys? Yes, this is one thing that you have to be very careful about. Opening balance sheet, when you prepare, all the assets are taken over at book value. Only one asset is revalued that you take. And obviously you have the PC directly given over here. Compare it with the net assets. If PC is more, it's goodwill. Otherwise it is capital reserve. Looks like a very easy question. But thing is, when you have to prepare realization account and shareholders account for both the companies, it's going to take some time. And when you prepare for Light Limited, everything is taken over. But when you prepare for Bright Limited, this is not taken over. So you have to be careful when you're preparing realization account. Yes, guys, that should be it with that particular question. Let's go into question number 5. Question number 5, the summarized balance sheet of Super Limited and Clear Limited. Okay. Super Limited, Clear Limited. 14 mark question. Internal reconstruction done, amalgamation done. 14. What can be remaining? Only consolidation now. Share capital, reserves and surplus, long-term borrowing, short-term borrowing, trade payable, PPE, non-current investment, inventory, trade receivable and cash equivalent. Now you can see this Super Limited, Clear Limited, 8 lakh equity shares of 10 each, 5 lakh equity shares of 10 each, 1,50,000 preference shares of 100 each. You have general reserve as well as P&L. In long-term borrowing, you have 10% debentures and 9% debentures. One company has 10%, one company has 9%. You can see PPE and you can see investment in Clear Limited. Who has invested? Super Limited has invested in Clear Limited. So Super Limited becomes holding company and this becomes subsidiary company. Additional information. Super Limited holds 75% of equity shares in Clear Limited. Since the incorporation, very, very important point. We have the same kind of question in the study material where Virat Limited and Anushka Limited is there. Since the incorporation, that means when you're doing analysis of profits, everything is post. Nothing can be pre-incorporation because since the incorporation we are having 75%. Very, very important point. No pre-incorporation profits. No pre-acquisition profits. Everything is post-acquisition profits because we are holding 75% since the incorporation. 25% of trade receivable Super Limited is due to Clear Limited. Intercompany owings. Cancel it. Okay, just cancel it. No issues there. During the year, Super Limited sold inventory costing 2 lakhs. Who is Super Limited, guys? Super Limited is holding company. Holding company sold inventory to Clear Limited. That means holding company is selling to subsidiary. This is called as downstream. Holding company to subsidiary company. Okay. The entire inventory remains unsold with Clear Limited at the end of the financial year. Entire inventory is remaining unsold. So now what happens on this inventory? Whatever profit is there, it has to be eliminated. How will you eliminate? You have to remove it from the reserves and surplus also. You have to remove it from the reserves and surplus of holding company, and then you have to also remove it from inventory. Basically, double effect, remove from reserves and surplus when you are consolidating and subtract it from inventory also when you are consolidating. You are required to prepare consolidated balance sheet of Super Limited and Clear Limited. You cannot get an easier question. There is no bonus issue, there is no dividend, nothing, no revaluation of asset is also happening. Direct question, only thing is this, you have to be careful, no pre-acquisition profits, and here cancel the debtor. 25% of trade receivable of Super Limited is due from Clear Limited. Cancel that 25%, compute that 25% and cancel it. How much is trade receivable? You can see over here, trade receivable 5,85,000. Calculate 25% of that. Okay, that will be cancelled. Intercompany owings. Then here we have 2 lakh which is sold, 15% above cost, costing 2 lakhs. Directly they have told 2 lakh into 15%. 30,000 is your unrealized profit. Shouldn't be a problem. Easy question. Remove it from reserves and surplus. Also remove it from inventory. That should be it, guys. Either 6A. They've asked one question, 6A. Okay, guys, 6A. The following information is provided for the year ended 31st March 2024. AX Limited holds 70% shares in BX Limited. Okay, very good. Holding company, subsidiary company. BX Limited holds 30% shares in CX Limited. So for BX Limited, CX Limited is an associate. DX Limited holds 40% shares in CX Limited. So for DX Limited also, CX Limited is an associate. DX Limited holds 49% in EX Limited. It's holding 49%. Again, EX Limited is an associate. Identify the related parties for the reporting enterprise AX Limited. For AX Limited, this is subsidiary company. And subsidiary company is having CX Limited is having an associate. So directly what happens now? Okay, for AX Limited, CX Limited and EX Limited, everybody they are asking. Okay, so AX Limited has a subsidiary, BX Limited has an associate. Associate will not be. Indirect subsidiary will be a related party, but indirect associate will not be a related party. Okay, so you have to be careful about that when you're doing for AX Limited. CX Limited, if you see, CX Limited, what it has, all people who are holding shares in them only, obviously they are all going to be related parties. EX Limited, what it has, EX Limited has DX Limited which is holding shares. Again, indirect associate will not be considered as related party. If DX Limited would have sold its investment in EX Limited on 1st October 2023, but goods were continued to be supplied by DX Limited to EX Limited throughout the year, will this scenario change your answer in respect of any reporting entity mentioned in point 1? Okay, they sold on 1st October 2023. What you have to remember, if you are a related party at any time during the year, then you will be considered as a related party on the reporting date. Anytime during the year, if you are there also, if you had a situation on one day you became related party, still it will be considered. Okay, goods will continue to be supplied. But after you lost your related party, after that whatever goods are supplied, that will not be considered as a related party transaction. But are you a related party at the year end? Yes. Because at any time during the year, if you are related party, will be considered as related party. Give reasons as per AS 18. This should be your answer, guys. Okay, in detail we have discussed. Then we go into the next one. Given below is the balance sheet of Sky Associates on 31st March 2023. Okay, you have capital, P&L, all that information is given. Additional information, the firm is planning to shut down its business with immediate effect on 1st April 2024. Sale and purchase of the firm for the year 2023-24 amounts to 8,20,000 and 6,50,000 respectively. Value of closing stock is given. Net realizable value is 120%, of course, that is also given. Other expenses for the period, deferred expenditure for getting amortized 5 years starting from 31st of March 2022. Remaining life of machinery is expected to be 3 years. Realizable value is given. Expense is also given to be incurred to realize the same. One of the trade receivable 5,000 is expected to be unrealizable due to an ongoing dispute. Okay. Bank has charged penalty of 2,500 crossing the overdraft limit. Lender has agreed to forego 50% of the interest charge for the year. The firm is expecting a discount of 4,000 from creditors. You are required to prepare P&L account for the year ended to ascertain profit or loss. Okay, they have asked this question for 4 marks. Why they have asked this question to calculate P&L for the year ended 31st March 2024? You can see over here, the firm is planning to shut down its business. Everything NRV has to be considered. Firm is planning to shut down its business. Okay, this similar question is there in our material as well. So should be an easy 4 mark question, but obviously it's going to be time consuming. Okay, you have to be on your toes, guys. Next, following information is available in respect of Z Limited on 31st March 2024. Now here what did they ask? Can you see a easy buyback question? Company decides to buy back 20% of its equity share. Decided, they are not asking you. Don't sit and calculate maximum permissible buyback and all. On 1st April 2024. Buyback is as per the provisions of Companies Act and company has passed necessary resolutions. Okay. For this purpose, it sold its investment, pass the investment entry. They sold it at a loss here. Okay. You are required to pass necessary journal entry. Investment is sold. Then buyback due entry you are going to pass. Buyback payment entry you are going to pass. Premium entry you are going to pass. Premium you can take from your securities premium. If required, you can go into revenue reserve also. Then obviously you are going to create CRR. CRR for the face value of the equity shares bought back. This should be a easy 4 mark question. Okay. Next, we'll go into the next one. Give journal entries with narration in the books of independent branch of a business to rectify or adjust the following. Independent branch 6 mark question they have asked. Now see over here. Commission income of 7,500 allocated to branch by head office, but still no entry is passed in the books of the branch. Commission income of 7,500 we have put into branch, but branch has not allocated this. So now what happens? Branch has to take it as income. So now branch books, what will branch do? They will take commission, okay, commission because it is income. Who has given them that commission? Head office. Head office debited to commission account, but still no entry is passed. Okay. Head office paid 12,000 directly to one of branch supplier. The intimation is received by the branch on reconciliation of bank statement of branch with its books. Okay. Directly they have paid to branch supplier. So what has to be done? To creditor has to happen because supplier is gone. Who has paid? Head office. So head office account has to be debited. A remittance of 85,000 is sent by branch to head office, has not been received by the head office. So in head office books, what will head office do? They will write cash in transit. Okay. Cash in transit debited to branch account. Cash in transit debited to branch account. Branch paid 9,800 as salary to head office employee, but the amount has been wrongly debited to salary account. Who paid the salary? Branch paid 9,800. So what we have to do? Branch account debited because we have to pay to branch. Branch account debited and it has wrongly debited to salary account. So you'll write to salary account. Branch account debited to salary account. Clear? Branch purchased furniture of 18,000 through check, but the furniture account was retained in head office books. No entry has been passed yet. Where is the furniture? So now you're going to write it's going to be retained in head office books. Furniture account debited to branch account because branch has paid. No, furniture account will be debited in head office books, but branch has made the payment. So branch will give the credit. Branch incurred 5,500 of expenses on behalf of other branches of head office. This transaction was not yet recorded in the books of branch. Not yet recorded in the books of branch. So what will branch do now? Head office has to give me money, boss. Head office account debited to bank account because I have paid the amount. Head office account debited to bank account. These are the transactions. 6 marks question they have asked. Yes, students, that should be it, guys. This is our paper discussion inside 1 hour. We don't want you to waste too much time on your exam preparation for the next exam as well. So within 1 hour, inside 1 hour, we have discussed your MCQs, all answers of MCQs we have discussed, and also we have gone through the descriptive part. So I hope you have done well, guys. I'm sure you have done well. Okay, easy paper it was. I'm sure it's lengthy. Always we tell that exam, advanced accounting, you have to go to the exam thinking that it's a lengthy paper. Okay, now leave the baggage behind. You have seen what you have done. You've got a rough idea. Go with full throttle. Full throttle, you have to go and prepare for your next exam. Next exam is your law exam. Full dedication, full focus. Take some rest now. Okay, take a break, sleep for a while, get up and start preparing. Start with the easy chapters, and as you go ahead, finish all the chapters, and please, okay, sleep, get enough sleep so that whatever you have studied, you should be able to recollect in the exam hall. Stay calm in the exam hall, guys. That should be it. All the best. I'm sure you all will clear all your papers this time in your CA inter level, and we will soon meet at the CA final level. Thank you. Bye-bye.